Good morning, everybody, and welcome to the Daily Energy Markets podcast. It is the 15th of March, the middle of the month, knocking on the door of the end of the first quarter, and Brent crude oil is trading above $85, closed yesterday above $85. It's dropped off a little bit this morning in Asian trade, but ultimately closing above the previous close. There is a market consolidating here, looking like it does want to go higher. We're finally maybe breaking out of the sort of stagnant tight band rate that we'd seen for some months. Let's welcome Clyde Russell, Asia commodities and energy columnist for Thomson Reuters. Your thoughts, Clyde, if indeed this is the moment that the market starts to move with the second quarter beckoning and a typically seasonally higher demand?
Well, it's interesting because I'm not really seeing much evidence of higher demand from where I sit looking at Asian markets. What I'm actually seeing is at best steady demand in Asia and some areas of concern. So to me, this seems to be, the recent sort of gains in prices really seem to be a supply-driven story, and those lingering geopolitical concerns that have kind of put a risk premium into the market. So I think, if we're looking at the market at the moment, I think it's supply that's driving the prices. Demand certainly isn't, not in Asia. You're looking at a fairly soft March, expected arrivals. And the higher prices go, the more under pressure imports will come, if you're starting to look around May, June. So, yeah, I'm not convinced that this is a sustainable move higher.
Well, let's go to Henning Gloystein, Director, Energy, Climate and Resources at the Eurasia Group. Is this then, Henning, driven by the sort of recent resurgence in geopolitical risk, perhaps, that we're seeing drone attacks on oil refining infrastructure in Russia, of course, the ongoing disruptions in the Red Sea? Your thoughts on what is giving this market a lift this week?
Yeah, thanks. So I kind of agree with Clyde on the demand side. There doesn't seem to be a real big push upward. But on the supply side and the geopolitics stuff, yeah, absolutely. I mean, I can understand why markets have become a little bit more jittery, and that infamous risk premium has increased a little bit. If you look at, you mentioned, Sean, the Ukraine, there's like regular attacks on Russian oil refineries now. Now they're not really a big threat to global supply of crude oil. But this is the same war that caused the biggest energy crisis in of the last, well, I don't know, 50, 60, 70 years, since at least the OPEC crisis. So the fact that Russian refineries are a regular hit now does make Europe very, very nervous. And Europe is a market that's kind of tight on middle distillates still, so the diesel market, which has low stocks in North America as well. So there are worries here, and if this gets worse, this is going to impact Europe again, because Europe is also most affected by the Red Sea issues that you also mentioned. So as a single matter now, the Red Sea has been handled very well by the oil markets. So Europe is getting the oil it requires from the Middle East by detouring it or by still putting it through the Red Sea. But there are concerns. And if you take ongoing or resurgent concerns around Ukraine, ongoing concerns about the Red Sea, and then the ongoing cuts by OPEC, then I think a price of for Brent in the mid 80s, around 85, is understandable. So I'm not entirely surprised by this, but at this stage, I do
You
not
sound
think...
like you're nearly contradicting yourself. You started out agreeing with Clyde, and then
well, that was the demand side,
getting a bit more bullish as you went.
It's the demand side, but so to end that, it's so because the demand side still looks relatively weak. We don't currently think that oil prices will be going much higher from here. So we have our cap currently still around $90. So we don't think it'll go higher than that.
Well, that's a big number still. Bora Barryman, managing partner, Hormuz Straits Partnership. Clyde and Henning, a little bit bearish in their thoughts, but ultimately, interest rates, we saw the inflation numbers come in earlier this week. Everything's looking a bit toppy. No interest rate cuts on the immediate horizon. Your thoughts on the intersection point for the monetary policy outlook and the oil markets?
Absolutely. I think the primary factor that is kind of moving these numbers, perhaps counterintuitively to some of the demand data, which my colleague just mentioned, is the macro situation, the inflation outlook. It's sticky. That's the headlines in the conventional kind of media today. It's here to stay. At the same time, the U.S. economy is booming along, right? So the Fed policy is going to keep rates more or less where they are. The U.S. bond yields are at pretty much the upper range of where they have been for the past few months. And look, we really can't expect inflation pressures to ease when we have major wars going on around the world that are being funded by more debt and money printing. So with that, you see the correlated dynamics and phenomenon in the Bitcoin markets, which are surging to record highs. And we know that a significant sort of tranche of the oil market is traded in Bitcoin these days. So therefore, that puts some, let's say, pressure on the dollar-denominated oil markets. Hence, we're at this sort of 85 level, which is quite robust given the overall supply-demand dynamics.
Clyde, just to challenge the thesis that you don't see demand anywhere. Ultimately, we saw in China, which is a space you watch closely, in import data for January and February up higher year on year. U.S. economy, as Boris mentioned, they are doing very well. The Fed are going to struggle, I think, to raise interest rates at all, or to decline interest rates at all this year. And we had the IEA out yesterday revising upwards their demand forecast for the year, sort of closing that gap ever so slightly, it has to be said. But nonetheless, typically they get into one of these trends and each month they revise it again and again. But those are some pretty, significant demand forecast outlook. No, and we're going into the second quarter. U.S. driving season kicks in. All in all, would they not add up to more demand, more price elevation?
I love looking at statistics and things. And so if you were actually looking at the media reports on China's January, February imports, you would have actually got quite a positive picture. Yes, they were up year on year, and they were actually up fairly significantly year on year. But what that doesn't tell you is that they've been in a declining trend since August. So if you actually look, Chinese imports peaked in that sort of June, July, August period last year, and they've been going down ever since. So what's more important, a 4 or 5 month declining trend or a year-on-year increase? I'll go with a declining trend because I think that speaks to more what's going to happen. The thing that I've noticed more and more about China is they are an increasingly price-sensitive buyer, not just of oil, but of all commodities. So when you have a sharp increase in the price of oil, as we got towards the end of last year, that works with a lag to cut imports. They'll dip into their stockpiles. So that's why you're going to see probably a fairly soft outcome in March. We're looking at another month of declining imports. It will be the 4th straight month of declining imports in China if March does come in weaker. So
is that also? I just wanted to jump in on that and say that those weakening imports perhaps also reflects a very full inventory environment in China.
Well, we know they've actually dipped into inventories quite a bit in the last year, having built them up dramatically in the previous years. 2020 onwards, they were building hugely at that time. So we have seen them, but what we actually are seeing is that they're prepared to use their inventories as a sort of commercial thing. If they believe prices have gone up too fast, too quickly, or too high, then they just cut back on their imports. So your sort of base level for Chinese imports are probably about 10.5 million barrels a day. That's likely what we're going to see in March. That tells me that that's just the minimum amount they need to import to run their refineries. If you want to talk about strength in China, you've got to look to see when they're starting to import 11 plus million barrels a day. Then you could say that Chinese demand is good and rising. But it's not just China. The whole of Asia is actually, fairly soft. March looks like another month of declining, so it'll be the fourth straight month of declines for, Asia as a whole. You're talking the world's top consuming region, 26 odd million barrels a day.
I mean, how does that align, Clyde, with the 5% projected DGP growth for the year? I mean, ultimately, that would seem to indicate a higher trajectory of demand of oil imports, 5% rather. At these levels, it feels more like a 3 to 4% growth.
Well, if they do achieve 5% GDP, that does imply that there will be some growth in oil imports. You've got to factor in the Chinese are moving as fast as they possibly can to electric cars because they prefer to use coal to generate electricity than imported oil. But overall, if they do get the economy going, that's likely more a second half story rather than a second quarter story. So the second quarter may actually be fairly muted for China's demand for not just crude oil, but for all commodities. And if they do get an acceleration, that's likely to be a second half story.
Henning, I wanted to get your thoughts looking forward again, this geopolitical risk premium, or the outlook for the war on Gaza and Russia's war in Ukraine. Are these likely to get better or worse as we come out of the winter? I mean, pretty dramatic statements yesterday by the U.S. head of the senior Democrat in the Senate. Pretty strong words condemning Netanyahu. I was trying to read, is that bullish or bearish? Is that good or bad? Is this going to get bad, going to get worse or better on the back of such statements? But your thoughts on the outlook for these two major geopolitical events. What's Eurasia thinking as we move into the sort of spring months?
Yeah. So in the Middle East, there are a lot of worrying moving parts at the moment. I mean, you mentioned indeed that from the US, the pressure on Netanyahu, on Israel to actually implement some form of a ceasefire, as temporary as it might be, is increasing. But there is still a risk of an Israeli offensive on Rafah, which would make things much worse, without a doubt. And of course the situation between Israel and Lebanon with Hezbollah is worsening at the moment. We still don't think this will turn into a regional conflagration, a regional full-out war, because none of the big players actually want this. They are working to prevent this, but the crisis is not over. The ceasefire that everyone has been saying it was imminent over the last month and a half, well, it's been elusive. So unfortunately, we don't think there is an easy path to a credible ceasefire in the Middle East at the moment. In Ukraine, unfortunately, it's similar. We're coming out of the winter months now, which means spring. And that means that if your military is strong enough on the ground, you'll be able to start an offensive more easily than you do in winter. And unfortunately, this at the moment is Russia. They have more troops on the ground. They have more ammunition on the ground. They've been preparing for this. And Ukraine's offensive last year didn't work. So that we do expect an offensive by the Russians at some point. And they can probably already an offensive, because we can see that there's been backtracking by Ukraine forces, and Ukraine is resorting to drone attacks within Russia. These drones are made within Ukraine, so they don't rely on Western aid on that. And that Western aid, Europe is kind of on its way to supplying a lot more aid, but it's slow because it's Europe, and in the US it's kind of stuck. So unfortunately, that means that war is now in its third year, and it isn't looking like it's going to go anywhere. So we maintain Ukraine looks de facto partitioned at this stage, and where that will lead at this stage, it's not going to be a happy, peaceful ending anytime soon that will dissolve the situation.
Yeah, it does seem to me that going into the second quarter, we're more likely to see a risk premium increase rather than decrease at the moment. Bora, your thoughts just looking at where Europe goes vis-a-vis the monetary policy. Will they be able to move before the Fed in cutting rates? Or is that a likely pathway? Your thoughts on that?
My gut feel is they should. I don't know what would be holding them back, because
it seems
Germany,
their inflation rate seems a bit more under control than the US.
Indeed, it seems a bit more under control than the US. And what's more important, in my opinion, is that their economies are suffering and in dire need of growth, uh, in with respect to facing the very large debt overhang that most of them are facing. Yes, Germany is not as indebted as the rest, but their economy is in the poorest shape, and that's not going to change anytime soon due to their overall energy dependence and the fact that they have not found uh, uh, the holy grail of green hydrogen or whatever they were hoping to transition their industry into.
But
And
are they, I mean,
they
how do
need
you
some stimulus.
explain?
They need some
I mean,
stimulus.
how do you explain, which is really confusing to me? There's a few things that are quite confusing, that gold and Bitcoin going up at the same time. But the other thing that's confusing to me is that the DAX, the German equity market index, continues to reach records just in the last few days. How does that coexist with the perception that the German economy is in the toilet? I don't understand that.
Very interesting. I haven't studied the composition of the DAX, and I could
But it's for
speculate
quite
on that.
industrial, it's full of all the
But
cars and the Siemens and
yeah, I think with respect to the Bitcoin and gold, clearly, I think it's part of the tectonic movement that's accelerating. We're in this earthquake right now. The U.S. is saying to its foreign adversaries, "Don't use the dollar." Right? I'm going to confiscate you. I'm going to make it painful for you. And their foreign adversaries include the largest economy on the planet. Right? So there's got to be a shift into other forms of currency reserves or FX reserves, right? So you can hold gold, and other players like Iran, Russia. I don't have the data in front of me, but I'm sure they're quite interested in these Bitcoin blockchain based payment systems, and and of course America's trying to like block the exits to that and somehow choke them to death or cut off their air, but that's not going to happen, right? Hence you have that asset class becoming more important. And if with respect to the DAX, look, we have this kind of soft power impression of Germany as a innovative, technologically forward-looking country, and Daimler and the rest. If they are making moves toward the energy transition and advanced electric vehicles, etc., and battery technologies and the rest, they're those stocks should be doing well. I don't know if they are though, so that's just my guess on why the market there is moving upward.
Clyde, just to drill down a little more into the situation in China, we're seeing again reports out by your colleagues in Reuters News that house prices continue to decline. And you talk about inventories declining month on month, or imports rather declining month on month. We have house prices in China continuing to decline, but not collapse. I suppose that's the good news, is it?
Yes, I think there's a lot of concern about the property sector, and you read a lot of stories about the problems that liquidity problems that the big developers are having, and that sort of feeds into this impression that China's at some kind of massive standstill. It's not. If you actually look at things like steel demand, there are certain parts of steel demand that are actually doing quite well. Infrastructure, non-residential construction, so things like schools, government buildings, army bases, that sort of construction, that's all doing pretty well. Even their manufacturing is doing okay. So China's a lot more nuanced than it used to be. I mean, everybody is accustomed to seeing China as a big super tanker that, it steams along, and then when it stops, it slows down and it's hard to turn around and that kind of stuff. I tend to see the Chinese economy now as like thousands upon thousands of little boats all trying to sail in the same direction. And when they get that right, it looks impressive, a big fleet sailing towards you. But every now and again, the chunks get blown off course or whatever. And I think that's kind of where China is at the moment. Some parts are working quite well and other parts aren't. And I think Beijing
it would be, are we caught in a false sort of narrative of too focused on the property sector as some kind of bellwether for the wider economy?
Yes, I think, I mean, there is no doubt the property sector is important, but there's probably two things to notice about that. One, it's not as important as Western media tend to think it is. And two, it's probably not in as bad a shape as some of the numbers and the narrative may suggest. So those are two things that are worth thinking about. If you look at it, China still produced 1 billion tons of steel last year. It's basically the 5th year in a row that they've done 1 billion or close to 1 billion tons of steel. This is not an economy that looks like it's collapsing or falling over. They are still making a lot of stuff. They're still building a lot of stuff. And, I think, to my mind, you need to take a much more nuanced approach to China's economy at the moment and look for the areas of strength and are they offsetting the areas of weakness. I think I'm starting to see some positive signs emerging in China, but I think, again, it takes a long time to get that sort of momentum going, get all my little boats going in the right direction. And that's why I think it's more of a second half story.
Second half story. Let's go to the survey question today, which is sort of touching on this continued outlook for the oil prices. My sort of theme of the week is this a breakout week for Brent crude oil? We see WTI also trading above $80. So the question ultimately is Brent crude oil prices will end Q1, which of course is only in 2 weeks' time, at closer to $90, closer to $85, closer to 80, and so on. Your thoughts on that? We'll put that out on social media as well. The idea that this is a breakout week and oil prices will continue to rise here into the second quarter. Henning, I wanted to get your thoughts back to sort of Eastern Europe and all things Ukraine, etc. There is actually a presidential election in Russia this week. Today, I think the result comes out, but ultimately, does it matter? Is this, I mean, obviously it's a sort of rubber stamp situation here, but is there anything on the sidelines of, or the tangents of this re-election of Putin that we should be paying attention to?
I think it's fairly safe to say we know who's going to win it. To be fair, though, Mr. Putin remains, by all we can judge from the outside, fairly popular in Russia. So even if it was a totally fair and open election, he'd probably win it anyway. So it's worth saying, and that I think is worth keeping in mind for outside of Russia. He tends to be portrayed as this dictator now, who sits there and starts wars with. I mean, part of this is true, but he's a relatively popular dictator within Russia, and that means we don't really expect much resistance from within Russia to what he's doing. Outside of Russia, so that's important. Important for Russia to be aware of, and it was discussed a little bit earlier. Says the European economy, we think, is actually improving. It's coming out of a trough. I spent a lot of time with European industry over the last 2 weeks, and they all kind of say Q4 last year, Q1 this year, sort of the bottom of the valley, and we're going to get out of this because energy prices have improved. And whether oil is at 85 or 90 for the industry, they've adjusted to that. For them, it's natural gas. That's come off massively. The orders are up. What they will, and
maybe that's why the DAX is looking so good, because gas prices in Germany are.
It might be, and the other aspect is, I mean, EU defense spending will have increased by $50 to $60 billion over the last year between 2023 and 2024 because they're going to achieve that 2% of GDP target. That all goes into heavy industry. They consume a lot of steel, plastic products, even cement if we build air bases and stuff, that sort of stuff. That's going to increase, and this is going to be at some point. A lot of that will actually go to Ukraine. Again, that won't resolve the war, but this is worth if you're sitting in Russia to see the European defense situation and the economic situation we think is actually improving.
Bora, I wanted to get your thoughts, of course, just because you do sit in London most of the time, and see what's going on in the UK. I mean, this new laws, you're a terrorist if you go and protest on the street. What's the dynamic there? We saw right-wing government or election success in Portugal after it. We've seen it in Holland recently. Should we expect that the Conservatives could actually pull this one out of the bag with all of these draconian laws they're passing?
In short, I would say no. I think what they're jockeying for is who's going to control the Conservative Party in the future. So these are all sort of inter-party moves and machinations. Uh, and just going back on Hennig's comments and observations, Putin is popular because the Russian economy grew 3.6% last year. And Netanyahu is unpopular because their economy shrank 20% or so in the past quarter, right? People they're happy to be jingoistic if the bread and butter is flowing at home, and they get quite desperate if that's not the situation. And coming back to the UK, the economy is muddling along. It's on par with its sort of European peers, which is not very impressive, and there is not a whole lot of wage growth going on. There are glimmers of hope, right? There can be glimmers of hope with the energy transition, and these areas are quite innovative and moving quickly. But I don't think the conservatives are campaigning on those issues very effectively, and I don't think they have their finger on the pulse of the issues that are important to people on the street. I think both the Labor and the Conservatives have certainly gotten these protests wrong, because everybody and my neighbors are on the streets, and those rallies are only growing while they're going out there and saying these are extremists. That doesn't sound like a winning campaign slogan to me.
Just a follow-up on that, Bora, because obviously you watch credit very closely. We have a significant headline in the FT today: corporate defaults at the highest rate since the global financial crisis, as reported by S&P. Is this sort of the tail of interest rate hikes that we saw last year starting to feed through now, and we have to keep an eye? We're not out of the woods yet of the lag of the tail impact of such a rapid rise in rates?
I think there is quite a lot of sort of competitive pressure on companies to deal with inflation as a phenomenon in general, because consumers are very price averse, right? And they don't have a lot of spending power. That's kind of that's the consumers that are, I guess, your average Joe consumers. I see that some companies are defending themselves by saying, well, we have to raise prices because the upper end of our customers, they don't feel inflation. And that goes back to this bifurcation of the top 10% and the rest of the 90%. The top 10%, they could spend, they're getting their money, and they have access to lines of credit, and everyone else doesn't. So depending on which segment of the market you're focused on, I think this inflationary and interest rate pressure, it can be quite severe. The kind of mass market type firms will have some pressure, especially if they're in kind of very competitive industries. Clearly, your Facebooks and your Apples, they're monopolies, so they don't feel that type of pressure. But if you're just sort of restaurants and commercial property, you feel a lot of pressure because the rates for property are going down. You can't get the rental income that you used to be able to get. There's no monopoly for you, so you're exposed to the interest rate risk, and that's not going away.
I met somebody last night at a social who's a big multinational with big property rental in London, and they were up for renewal on their rent. And he told me they're renewing with a revised down of 25% on their rent for their city centre London property. Last word to Clyde. This follow through for Asia, if indeed interest rates do stay higher for longer through 2024, is that pain for Asia?
Yes, I think what it actually does is, I know it's kind of boring, but it means that we sort of bump along where we are. You see reasonable growth in some of the more developing countries like India. but not too much in the developed parts like Japan, Australia, South Korea. And I think you just sort of see this bumping along. And that sets up the oil market for really an ongoing battle between OPEC and its supply cuts and a sort of lack of real strong demand growth.
Well, we'll wrap it up there with our survey results showing that 85 might be attracting most attention for the end of the month, sort of sticking where we are really, or will we break out to that $90 mark that even Eurasia have acknowledged might be the ceiling. Thank you so much, Henning Blostein, of course, as always in London, and with Bora Berriman down the street in London, and Clyde Russell in Australia. Really appreciate your thoughts and insights. Have a great weekend, everybody. We're back Monday morning, 10:30 UAE time. All the best. Thank you.
Thank you.
Thank you.